is Breaking the Mould, our regular look at the financial markets with investment director Russ Mould. Russ, how are you?
I'm very well, Clara. How are you?
Not too bad at all.
Spring is in the air.
It is, and I'm looking forward to Easter.
Very good, yes.
Chocolate eggs.
Ah, yeah, no, that makes me fat. I'd rather have a sausage roll or a piece of cheese myself, chocolate.
They still make you fat.
Yeah, but don't make me spotty.
Right. Russ, what's the fun?
Okay, well, it is going to be, well, by the time we're out with this, it's going to be the week after Easter probably. It's going to be very, very quiet for corporate news, as everybody will still be digesting their chocolate eggs, I suspect. There is a couple of sets of corporate results coming out, but with apologies to any shareholders out there in the media firm Huntsworth or oil and gas explorer Ameriso, I'm actually going to gloss over those. But at the end of, that's not because they're not important, but there's just some bigger things going on at the end of a quarter. I think it's often worth taking stock and looking at what has caused a fuss. Now, markets aren't always efficient, they're not always right. If they were, it'd be impossible to make money. But they are smart. Always respect the market, even if you don't agree with it. And the first quarter of the year has thrown up some interesting trends.
Yeah, so what is it that's floated the boat of the investors in the first quarter?
Yeah, I mean, regular viewers know that I like to do with this by sector, in the belief that a bad stock in a good sector will tend to outperform a good stock in a bad sector. So if you think you're onto a theme, it can make filtering for stocks a bit easier. So if we look at the 5 best performing sectors in Q1, they were, in order, forestry and paper, industrial metals, food and drug retailers, life insurance and media. And the first chart behind us shows their performance in absolute percentage terms. Now they're all up at least 17%, when the market's up a still respectable 7.5%. Now the second chart is one of my favourites, it's from our good friends at Shares, and it shows how these 5 weekly rankings compare to all of the 39 industrial groups in the FTSE All Share. And again, so the better your performance, the higher up the rankings you are, and you can see from this quintet, up like that, a little bit like Lenin calling for a taxi, all those statues that you used to see.
All the way up.
It is.
So it's a big switch from last year, isn't it? I mean, 2013, the winners there were relatively defensive plays like healthcare, tobacco, and food producers.
They're kind of out with the washing. But I'm glad somebody's paying attention. Well done. It's been a huge switch, and the theme here seems to be this move away from reliable stodge to more economically sensitive areas. The surge in forestry and industrial metals suggests the market is looking for an improvement in economic momentum. Thank goodness, after about 6 or 7 years. Media is very exposed to changes in consumer sentiment and perhaps the fall in oil, which we've talked about a lot, sliding inflation and early signs of real wage growth, putting some more money in people's pocket and a little bit of confidence for good measure. Now also, sectors like forestry, metals and media have got big dollar exposure, and the greenback's been a huge riser in the first quarter. That also may help, while life insurance has done quite well.
Okay, so if those sectors have been making the markets springers so far, what have been the losers?
Okay, we've done the hares. Should we do the tortoises? Yeah, I think that's probably the way we're... And the 5 laggards are banks, oil and gas producers, gas, water, multi-utilities, food producers, electricity. Very clear difference between the previous 5. Again, defensives, you mentioned it, they were big last year. It's not happened this year yet. Big shift in market sentiment, again suggested from fear to greed, from risk off to risk on. And that trend can generally be seen globally. Equities have done quite well, buoyed by the launch of quantitative easing in the Eurozone and Sweden, and interest rate cuts from over 20 central banks worldwide. Money is looking for a home, returns on cash in the bank, not very good, and money's sloshing around. Now, we've done the 5 tortoises' absolute performance. This actually shows, again, their rankings relative to the whole 39 sectors, and again, it's just straight down like that.
Yeah, so not going anywhere
Not at the moment,
very fast at all.
Not in the first quarter.
So where do we go from here?
Well, I think in the end, if you look at those, for these trends to continue, hares and tortoises, I think people will need to keep faith in the fact that the UK and the global economy are finding momentum, that the consumer is going to keep on feeling more confident, that interest rates are going to remain anchored, and that valuations remain attractive. So that's what people will need to keep thinking for those trends to continue. And they're all going to remain the subject of fierce debate. I mean, for me, the big risks probably going forward are all look kind of like a US slowdown. The data's been very, very spotty for the first quarter. Let's hope it is just the weather, as the economists are saying. Secondly, strength in sterling. Does it hobble exporters? Though that probably won't trouble the consumer stocks too much. And then perhaps the biggest one of the lot in the very short term, 7th of May, general election. Do we get a hung parliament? What's going to happen out of that? And that is uncertainty that could hover for some time if we end up with another coalition government.
Okay, thank you, Russ.
Pleasure.
Thanks for joining us. We'll see you next time on Breaking the Mould. Goodbye.